Hey there, everybody. Welcome back to another episode of Simply Investing. We're going to talk a little bit about the housing market and things going on right now, but really no news in the finance industry, just kind of dead as a doornail. Crypto's just hanging around 1.07 trillion in valuation. We still got stocks doing the downward trend that they've been doing, just slowly going a little trending down. But it's a little interesting when you start to look at the longer picture that we're really not that in that bad of a position. People have been ragging on Tesla for a while, but I think we broke past a good buying point. But it's hard to say because I would wait to see what their sales numbers of Teslas, even though in California right now Tesla is still the highest selling electric car. But we'll see what happens with it. I really think it's a good deal. But before we get into the main meat and potatoes of this video, I want you to like and subscribe and follow us, and also follow my other channels, Max Auto Detailing and Max Force Moving, and see what we're all about. Like and subscribe there. Give a little support. But I wanted to talk about how everyone's talking about there's this big crash in the housing market, and I just don't see it. I have a good graph here. So when they said we had a really big crash in 2008, this is the 2008 era from here to about here. So from here to here is where we had the delinquency rate, where we went from, we were like 8.5%, then to 11.4, then to the tens, and it just steadily declined, and we got to 2008. And right here is where the lockdown happened, right here. And you see it's still going down. So the delinquency is actually, I think, you're looking at 1.86 as the last reported. Now they are a quarter behind, or a couple quarters behind. They're about 3 months behind on this data, but it's 1.6 as of the end of the quarter three. So the end of September, beginning of October, it's 1.86% delinquency rate, and we're getting pretty close to where it was right before it spiked. So now, if we go through this spike again, we go back, then this is all data from the Census Bureau and FEMA, and of course, our friends over here at Economic Research. Uh, but we were looking over here, that only caused really not bad of a dip, and then prices went up. So if we calculate that dip, that brought it down the average price of a home roughly to about 175,000 at the bottom, and that was a 50%. Let me get out my calculator here, but that brought it down to, what's here? It was 50,000 divided by 225,000. So yeah, the pricing fell 25%. So now we're right up here to just shy of 400,000 currently. So if we're going to take a 22% hit on it, or sorry, 4,000 times point two two, so you're looking at 88,000% dip. So we should be right around the 300,000 mark, and that means things are going to yet start rising again after about 3 years of drop. Now, what's got me is that this was in 2008 was a combination of predatory lending and free money. And we had a lot of free money, but we did a lot of the regulations from this time are still in effect during COVID. So there wasn't a lot of predatory lending, I would say. Not as much as people would think. There wasn't as much subprime lending over the last 3 years. But the big thing is that they last year, beginning of 2022, they announced, Bank of America announced, and a few other banks announced that they will, for minority borrowers, no money down products. Now that that's going to come at a price because obviously the bank is going to price it to make money. So the only way I can think of that's going to make money is if it's an APY product, which is very bad for a mortgage. You want kind of a fixed rate, not really an adjustable rate on your interest that fluctuates with whatever the economy is doing, whatever the Fed's doing. And right now, the Fed, they just did a 0.25 rate increase. They're probably going to do at least four more of those 0.25 rate increases. They're going to keep going with those. So I don't know what I've seen some other people talk about that they should be slowing down. They're not going to. It's going to keep going because they already see this trend, and we're kind of ramping up to where it happened before. But still, it's not going to be as bad as it was before because not many major institutions are over leveraged like they were back then. It was much more regulated and much more concise now, but we're still not even close to a low because right now we have 1.86% delinquency rate. So that really means about two out of 100 people are who have a mortgage are defaulting on their mortgage or just behind. Now you see right here, it hit this for a while. We hit right there. That was 2003, and then we were no one's delinquent for a long time. So it was from 2003 all the way to right about here, 2007. It started to spike up. So we just got back to that area, and this is kind of coming off of the early 90s real estate crash too, where it was coming down from. So we had this real estate crash here. We should be going down, and we really should have a nice crash after about looks like what was that 1, 2, 3, 4, 5 years, about what I predict, 5 years of low delinquency, even though the interest rates are climbing, but low delinquencies. And then if we do have a bubble burst, it's going to happen right around year five. So that puts us at 2027 when we should be having that burst. But that's only a best guess on there, and that's just looking at the data that we have. But the one thing that is kind of scary is that the moving industry itself kind of went down in percentage, but the amount of inventory, and this is attributed to the real estate gurus that were on YouTube and Instagram promoting courses for Airbnbs, buy this home, rent it out, the whole quote unquote house hack system. Those people are selling because people are getting tight on their budgets. They're not Airbnb anymore. It's not worth it. It costs too much to maintain it. It costs too much to clean it, or you're doing it yourself. It's just not. It's just not sustainable. Plus, a lot of the big cities and tourist areas are starting to ban Airbnbs, so you're losing kind of the viable market that it was intended for, and people are going to be backing out of it. So those houses are now coming on the market along with people who did overbuy. So people who did not take into account the costs of owning the home, such as you got your dream home, you got the nice high ceilings. Now you're stuck with the bill of air conditioning, heating, water, utilities, all that stuff, and not to mention rising inflation right now. So those people are putting their houses on the market. What I do see is that a lot of houses a million and up are not going anywhere. They're just reducing, reducing, reducing. They're staying on the market a lot longer than the starter homes. The starter homes being the 3 bedrooms with 1 bath, 4 bedrooms with 1 bath, 4 bedrooms with 2 baths. Those not they're not the most spectacular. They're not the most stunning home, but they're functional home, and those are flying off the handle. But those are the ones between 100 and $250,000. That seems to be what this data is showing. That those people are still buying strong. And the economy purchases, our Rosh Coleman homes, they are still subdivisions left and right across the South. So the low end homes are still being bought, still being sold, still being purchased, and they're still within an economical buying point. They're not 300,000. They tend to stay between 125 and 175, and people are still buying those, and neighborhoods are still popping up with those. So it's gonna be hard to say, but I don't think we're gonna have a crash at any moment with this. And The best thing is saying just do your research. Wait, if you're looking to get into stocks and investing right now, probably just go get a program like Betterment or Wealthfront. Invest that way. Don't try to pick stocks, especially right now since everything's so volatile. And I would not get into crypto or do anything with it right now because it's just so volatile. And it's probably going to go down when people realize that the Fed is going to keep jacking up the rates. With that said, stay safe out there, guys. Do your research, like and subscribe. Follow me here. Follow the other channels and do best. Just like is free. That's all we ask for. And I'll be back with another video. Hopefully, same time tomorrow. It is getting busy, but I'll have another quick video for you. Thank you guys, and don't forget to like and subscribe.